This is the second presentation on the infinite banking concept. Today I wanted to dig a little bit deeper into some of the concepts we talked about last time. We talked a little bit about the circle of wealth and the concept of retaining money and recapturing money. In addition to that, we talked about financing and paying cash as and infinite banking as an alternative to those forms of purchasing. We're going to talk a little bit about how utilizing your policy is more effective than paying cash and financing, and also is an enhancer to other investments, whether that be new businesses or current businesses, or other investments of any kind, whether that's gold, silver, anything that you could imagine. How basically utilizing an insurance policy is going to be it will increase the overall yield on those investments. So we talked about financing and paying cash. If you finance a vehicle and you're always behind, meaning you're always paying someone else to borrow their money. For example, if I have to buy a car every 4 or 5 years, and I finance that car and I don't save up for it, basically in 4 or 5 years when I need a new car, I gotta finance it again, and I'm just continually and always paying someone else for the use of their money. That equates to a large amount of money that we lose out of our circle of wealth over a long period of time. Paying cash is a seemingly better option, simply because you're saving for that purchase, and you're not losing the interest to someone else. I kind of wanted to demonstrate, the use of the policy and borrowing from the policy. We'll also get into at the end of our conversation how a policy is structured correctly and in more detail on that. But I wanted to give you an idea of the functionality of the loan provision on a policy. So let's assume I need to make a purchase in a couple of years, and I do save up and I do pay cash. Well, usually what that means is that if I have my investments over here or my retirement savings over here of $50,000, if I'm making a $20,000 purchase for a car, it means that I've probably saved up on the side and not continued to fund my retirement in order to pay for this car. So I lose out on the opportunity cost of $20,000. Basically, had I retained that $20,000, not used it for a car, I would have $70,000 in my we'll call this our policy, because we're going to look at the difference of this, with utilizing a policy. So essentially means I lose out on the $20,000 and what that could do for me over the next 10, 20, an infinite number of years. But obviously we need to make purchases. We have things that we have to pay for. We're talking more about efficiency in making those purchases. So if I utilize if I pay cash for my next car, so we'll keep using that example. Basically, keeping the $50,000 in my retirement fund or my policy in this scenario, in 10 years at 5% compounded interest yearly, my future value is $81,444. So I've got the car and I've got $81,444. If, on the other hand, I had not paid cash and I had not saved up on the side for that purchase, and I had put the maximum amount I could into my policy, so $70,000 into my policy, and I borrowed out of my policy the $20,000 for the car. Essentially, what would happen is my $70,000 in 10 years at 5% would be worth $114,000. Now, however, in addition to that policy growth, I have a loan of $20,000 that I need to pay back, and we're going to assume a payback rate at the same that we're earning, so 5%. So $20,000 at 5% over 10 years is a monthly payment of $212. So I will have paid $25,455 back to the policy, meaning I've earned 114, I subtract the 25,400 that I've outlaid, and my ending growth is 88,566. So essentially what I've done is I've increased my wealth, and I've retained an additional $7,000 by utilizing my policy rather than just saving on the side and paying cash. So utilizing a policy is important when it comes to making your purchases because it can enhance what you're doing. So basically that's kind of the idea behind paying cash. I wanted to break down a little bit more what's going on within the policy. We'll stick it, we'll look at $20,000 as our purchase, but I kind of wanted to walk through what a purchase looks like. So if I have a need for a $20,000 car, essentially what's happening is I have $20,000 or $50,000 or whatever I have in my policy as cash value. Now, cash value is not, when you go to a bank and you deposit money, the bank doesn't take your money and put it in a back corner somewhere and label it your money. They credit you that money, and it's your money when you want it. So the same kind of concept applies to insurance. So if I have $20,000 in cash value, that is basically money that I can borrow anytime I want to, and the loan is collateralized by the policy. So essentially what I'm doing is I'm borrowing $20,000 from the insurance company's general fund, so to speak. So I borrow $20,000, and we're going to assume the 5% interest rate over 10 years. If I borrow $20,000 at 5% over 10 years, I will have paid $25,433. Okay? Leaving my $20,000 in there is beneficial to me. If it grows at the 5% over 10 years, my future value is $32,577. So by utilizing the policy, I create additional cash that I'm not earning by paying cash. So essentially what's happening is I'm collateralizing the policy, I'm borrowing the $20,000, I'm paying simple interest that equates to $25,000, and my policy is earning 5% at compound interest, which increases my wealth a lot more than other options. So that's kind of what's happening. The insurance company also, when it makes additional profits, it credits those back to the policyholders. So you really could be earning more than you're actually paying yourself back. But to illustrate this a little better, it's almost easier to understand when you look at an investment. So if I have the same situation, but instead of utilizing my policy as a way to purchase a vehicle or another expense, if my $20,000 that I'm borrowing is utilized in an investment of some sort, whether that be gold, silver, the stock market, a business, it can be used for whatever you want it to be. But if I'm able to do that, and let's assume I have an opportunity to earn 8% on my money. If I just come outright and I use cash for my investment is worth $43,178 at the end of that 10-year period. Okay, and then there's the taxes and everything that we're not going to factor in here, just to make it a little simpler. Well, what would happen is I would borrow the $20,000, the same situation. I would pay back $25,000. I would earn $32 on cash value, and my total returns by utilizing the policy would be $50,300. So my investment return using my insurance policy goes up about $7,000. In addition to utilizing the policy and increasing my wealth by doing that, I also get a tax deduction in this scenario of $5,455 because I'm paying interest on an investment. So the idea that we're trying to present is not that insurance is an investment that will grow and will outperform other investments. The idea is that the whole life insurance policy acts as a foundation for wealth to be built upon. So it's a better alternative than other alternatives. It's basically going to enhance everything that I'm doing. So if I need to make a car purchase, I'm going to save a lot more money by utilizing my policy. I'm going to recapture a substantial amount of money rather than always being behind and financing my cars somewhere else. I'll always have money working for me. I'll always come out more profitable than financing it somewhere else. If I need to, it doesn't inhibit me from being able to make an investment of some kind, whether that's any investment you want. It's just going to enhance and increase my returns. For example, $20,000 investment invested by utilizing and borrowing from the policy is going to increase that investment by about $7,000 and decrease the tax liability. So the insurance policy is basically it's simply an enhancer. It enhances what we're trying to accomplish. So the question that kind of follows this is, well, how is the insurance policy structured so that it is beneficial to me? A lot of people have kind of a misunderstanding of whole life insurance. There's a lot of reasons for that, but